Good evening, ladies and gentlemen, and loyal followers of the Clueless 8 Club. I'm going to go over tonight in a little bit more in detail on the 533 swing charts that I use as one of my proxies on determining directional bias in the market. Now, keep in mind these are swing charts and not intraday daily day trading charts per se. Neither are they 100% accurate, but overall, reading these particular charts and any charts for that matter, but these ones especially is not as much an exact science as it is an art, or I would say pattern symmetry recognition as identified over years of looking at it and using it as a proxy to having successful trades in the market. Now, saying all that, I call them the 533 charts. This was sent to a very good friend of mine from Canada, who is still a very good friend of mine, and I thank him for sending me this. And over time, I have somehow and somewhat mastered the art of reading these particular charts. So saying all that, let me go over this quickly here. These are swing charts, and in very simplistic terms, you can see what the parameters are. And again, I'm divulging one of my little secrets to you guys on when I say that the market's going to be up for another week, or it's going to be up for another 5 days, or whatever. Over time, you'll be able to master this too. So basically, what we have here is RSI, Relative Strength Index. We all know that. I have inputted the Russell 2000 here and S&P here. You can use any of the indices. You can even use this on individual charts, individual stocks. You can input it and try to figure out, where the swings or directional bias is. These are this is the Bollinger Band. Let me just take this out actually for now. Okay, let me take this out, and then I can go back. Those are simply the crosshairs. So these are dark lines here are the Bollinger Bands. Then we have I input the as one of the variables the 50-day moving average, standard stuff, and then the full stochastic, which is the 5.3, and then the directional what do you call it, the what's the name for it? I forget. The directional I again, I apologize, the percentage, the directional, whatever it is, So and that is the percentage D, and you guys who are real technical analysts can figure that out. So bottom line is that this is the way I look at it. Okay. Again, I am no guru. I'm just a fantastic reader of the market, and that has served me very, very well. And that's the reason why you guys are listening to this video cast. So these are the histograms. Obviously, the MACD histograms. Volume, I don't give that much weighting to volume anymore. Okay, there's a lot of stuff happening in dark pools away from the public markets, that take away a lot of the volume. And again, of course, a large volume sell-off, or a large volume capitulative sell-off, or a large volume buyout, what do you call it, speculative blow-off top is important. But in general, I don't really care about volume that much, because the reality is price movements are what makes us money. Okay, volume movements don't. So let's face it, as traders. So saying all that, when the stochastics turn with the crossover, they generally connotate a multi, and this is a weekly. Obviously, you can change it to a daily if you'd like, and I'll show you the difference on the daily. Quite different, showing that we are probably in the midst of a corrective sell-off. So the weekly is telling us that we still have a couple of weeks to go before we top, and that kind of hits the point of what I've been saying, is that we probably have till probably the first to second week of May or September, whether it be September 8th or whether it be a little bit after that, where we top. So, and that's exactly what's going on. So if I get my trusty drawing tool here, you're going to see that the stochastics turned over here, and that was back in February. And if this is the February pattern, which it looks most likely it is, then we are going to, let me take this down a little bit. then we will most likely, if this is the February pattern, then we obviously, or this April pattern, um, then we have a couple of weeks to go. So if you measure the weeks at the top of the Bollinger, we're looking at somewhere around 2020, 2030 as the tops. Which again, I've shown clearly in many of my other video casts. If you took the time to listen to it over the weekend, is exactly where the market's going. I'm going to show this on the ES chart on my other screen in a few minutes. So that's really as simple as that. When you see these histograms going into the green, it goes as a wave. Okay, so it has to get overbought. Overbought generally is around the 5 level. So it is right now at minus 2.5. So it has to get up to the 4 or 5 level before it gets overbought. By that time, we'll probably go and test the upper end of the Bollinger. This will peak around. This generally peaks around 91 or so at this level. Okay, I'm sorry. And that would. Again, one second, let me draw this on the Russell. So around the mid 90s is extreme overbought condition, and from that point the cycle starts again. So that means that this nice little histogram will go green, and then it will come down again. And this, we're getting overbought, we're getting there, and this means that we are most probably, on a weekly basis, we're going to test the 1200 level again on the Russell 2000. Now, let me make this point very straight here. There's not a single analyst or newsletter that I have read, and I'm sure there are out there, who have said from the bottom, like I have here, okay, that this was pattern symmetry was going to resolve itself, and that we were going to test the highs of the Russell 2000. I have been somewhat cautious, but that's the nature of a trader, to take profits along the way. But I've said that if we do cross over the 1180 level, and you can listen to my old video cast to validate that we will see new highs, or at least the all-time high on the Russell 2000. And I'm going to stand by that. Okay? So let me take these squigglies away. So it's really as simple to read. Okay, we have stochastics have crossed over. You can see past patterns. Always give a lot of weighting to past patterns, because human behavior in reality never changes. Every crisis is the same for different reasons. I coined that term way back in my early years on Wall Street, back in the 1998 Asian crisis time, and I'll tell you, it's the same old story over and over again. Every time it feels like this is something new and this is going to be the end of the world, or the euphoria comes in. The fact remains, we are very far from being euphoric, and we have one of the lowest participation rates in the market at this point, given past bubbles in the market, and that's a fact. I also posted an article which came out after the close on Friday, that apparently in August it was the first week or so of the first real positive inflows in the market by retail investors via mutual funds, and that does have an effect on the markets. Liquidity drives markets higher, and illiquidity or lack of liquidity drives markets lower. It's really as simple as that. So ask your favorite fund manager, whoever that handles your mutual funds, whether or not he or she is deploying real money in this market at this juncture, or they're still sitting aside and underperforming the general indexes, which is the worst thing that a fund manager can do. Hedge funds, I posted that article before, where hedge funds are trailing the market. Fact, okay? This is not me making it up. Hedge funds are trailing the market by a significant percentage. I believe somewhere between 5 to 7%, and that's a terrible number. If right now, if you're a hedge fund manager, you know what is on the line, and you're about to really get fired. So, same thing with retail traders and institutional traders. We are, even bulls like me are not deploying a large amount of capital. We're doing very well. And imagine the rest of the crowd out there, from the forums that we look at, the stock twits of the world, to all the newsletters, who are so supremely cautious, always calling for a 10-20% decline.